Welcome everybody to this public webinar on Productivity Commission's first interim report on the pillar inquiries, creating a more dynamic and resilient economy. My name's Alex Robson. I'm the Deputy Chair of the Productivity Commission, and I'm joined today by fellow Commissioner Barry Sterland. I'd like to acknowledge the traditional custodians of the lands on which we're meeting today and pay respects to elders past and present. So overall, for these pillar inquiries, we've been tasked with 5 separate inquiries. This one is around ways to create a more dynamic and resilient economy in order to boost productivity. So that relates to enabling businesses and people to invest and learn and innovate, promoting competition and supporting diverse business activities. This report was released last Thursday evening. We have a second report out today on net zero and investing in cheaper and cleaner energy, and also adaptation. The remaining 3 reports will be released according to that timetable you see on the screen. They are around data and digital and AI, skilled and adaptable workforce, and delivering quality care more efficiently. So in terms of this inquiry, the terms of reference were fairly broad. We were asked to focus on the key levers for dynamism and growth. That could have included everything from specifically focusing on innovation or openness or other topics. We decided, after receiving feedback from our productivity pitch and also consultation with many individuals and groups, to focus on Australia's corporate tax system in order to spur business investment, and also the regulatory burden, and specifically around regulation to promote business dynamism. So the way this presentation will proceed is that I'll cover the tax reform proposals, and then Barry will talk about the regulation and business dynamism part, and then we'll address questions at the end. So we're at the timetable in the middle there, where you can see interim report released. We are inviting further feedback and submissions at this stage. There'll be consultation that will be ongoing towards the goal of releasing a final report to government at the end of the year, which is then tabled in Parliament, and then it's up to the government to do with the recommendations according to their wishes. This has been an inquiry that's been going since December last year. As I said before, we've received a lot of ideas from the public in terms of the productivity pitch and also consultation. So the first topic, which I'll discuss, is our corporate tax system and some proposals for reform to spur business investment. There's a couple of key facts that inform the development of the proposal and how to think about it. The first is that business investment and capital deepening are key drivers of productivity growth. So over Australia's history, if you look at this graph on this page, over more than 100 years, capital deepening, so this is investment in plant and equipment and other forms of capital expenditure, has driven more than half of Australia's productivity growth. So investment enables workers to work smarter rather than harder or longer, and it enables workers to produce their best, given that they've got more equipment and new technologies and so on to work with. And so this investment story is a vital part of the productivity story, and the issue in Australia in relation to productivity growth is that it's stagnated basically over the last decade or so. And so a key place to look then is obviously at business investment. And if we break it down over the last 50 years or so, if we just take the GFC as a reference point, investment as a share of GDP, either measure if you include mining or exclude mining, it's declined since the GFC. It's declined by about 3.2 percentage points as a share of GDP, excluding mining. So that tells us that stall in business investment, that there is an issue, and we are concerned about it because of that productivity story that was in the previous slide, and the importance of capital deepening to that story. And one of the key levers available to government is the company tax system in general, and in particular the company tax rate. That rate is a key driver of investment in the sense that it affects after-tax rates of return on investments. And in Australia, internationally, we are uncompetitive. That has been a story that's happened over the last couple of decades. In terms of the headline rate, we're the I think there's 4 OECD economies that are higher than us, and everybody else is either the same or lower, and effective rates are also very high in terms of company taxation. So that is another piece of data that was a key piece of information that we took into consideration in thinking about growth and dynamism and investment and productivity. In addition to that international story, our company tax system, does penalise dynamism and investment. Now, to some extent, all company tax systems do that, but we think that Australia's company tax system does that unnecessarily so. And at the current rates and design, we don't think it's a particularly efficient tax. It disincentivises investment. It does have a bias towards certain ways of financing investment. And the way it's set up in terms of profits and losses, it can be a deterrent to business entry and risk taking. And overall, all of those 3 things feed into this general conclusion, which has long been known in Australia, that our corporate income tax system is relatively inefficient in the sense that the economic costs of those 3 things in the first 3 dot points are very high relative to the next dollar of revenue that the company tax raises. So what you want from an efficient tax system is to have taxes that don't create these kinds of economic distortions or don't do that unnecessarily, or do so at whilst raising quite a bit of revenue per dollar of distortion, and the company tax system doesn't do that. So it's a natural place to look for reform, and that's what we've tackled in this report. So our long-term vision for reform in this area is that we think that there needs to be a reorientation of the corporate tax system in Australia, and this involves 3 starting points. One is in terms of direction. We think that we need to decrease reliance on the company income tax as it's currently designed. So that doesn't mean abolishing it overnight or ever abolishing it. It means just decreasing reliance on it. So it's more a directional change. The second part of that is to introduce a more efficient way of taxing companies that supports dynamism and investment relative to the current system. And over time, the direction we would seek to move the company tax system according to our draft recommendations would be to fund broader effective reductions in company income tax rates, depending on the evaluation of the initial reform. So that's the long-term vision. It's a direction of change that moves us, we think, away from an inefficient system towards a more efficient system, whilst maintaining, in overall terms, from companies the same amount of revenue. So then the 2 first steps that we advocate in this report towards that long-term vision are that, for reasons set out earlier, we would introduce a 20% headline company tax rate for companies earning below $1 billion. So that addresses a number of issues around dynamism, investment, international competitiveness, and so on. And then at the same time, we advocate introducing a net cash flow tax of 5% on all Australian companies. There's a couple of reasons for that. One is that a net cash flow tax avoids many of the costs that are associated with the current system, as set out in those previous slides. It also recovers some of the revenue cost of reducing the headline rate, and we think it's a more efficient way of taxing companies. So first, to the 20% headline rate for companies with turnover below $1 billion. There are a number of positives to that. We think that will attract foreign investment. It will generate more retained earnings for domestically owned companies. And it turns out that there's a great deal of evidence that retained earnings is a key source of financing investment for many firms in Australia. In particular, that some of them are financially constrained. And so this would ease some of those pressures, opening up more investment opportunities. And the third component of it is, in addition to the headline tax rate cut, is that we are targeting that at companies earning below $1 billion. There's a dynamism and investment element to that, and there's growing international evidence that smaller and domestically owned firms are more responsive to a tax cut and they're more reliant on retained earnings to fund investment. And so that is one of the key justifications for focusing on companies earning $1 billion or less in terms of their turnover. This is, the vast majority of companies. It includes obviously small companies, some medium ones, and some large ones as well. So we think that will create a big boost to investment and GDP and productivity, and I'll go through those numbers in a couple more slides. We have imposed upon ourselves in this exercise a couple of constraints, and the key one, just in the footnote to this slide here, is that we think that a good starting point is to think about fiscally neutral, revenue neutral company tax proposals. And so that was something that we imposed upon ourselves. There are a number of other ideas floating around out there in relation to changes which may not be fiscally neutral. We've considered in this exercise that revenue neutral is a pretty good goal to have, and that's over the medium term. That we've imposed that constraint upon ourselves in assessing these things. It's not a year-to-year revenue neutral exercise that we've engaged in, and so that's an important consideration in thinking about our proposals in this interim report. So in addition to the 20% headline rate, part 2 of our proposal is a tax on net cash flows of 5% on all companies. We think it's better for dynamism and efficiency. So for the purposes of calculating that tax liability, CapEx or investment is immediately and fully deductible at the time investment is made, in contrast to the existing company tax system. Losses would be creditable against company income tax, and if that's not possible, uplifted at the long-term bond rate. So that goes to incentivising risk-taking and the treatment of losses. And in addition, under our proposal, interest payments are not deductible, but obviously upfront investments are, and therefore this reduces the bias between different forms of financing in relation to debt and equity. So those are the key components of the net cash flow tax. In the interim report, there's a number of obviously details that have to be gone through and worked out. We are looking for feedback and consultation on all of those things, and we're happy to receive comments. But those are the broad sort of parameters of the proposal that's set out in this interim report. In terms of the administration of this, it should be relatively straightforward. Net cash flow tax only requires some minor tweaks to the calculation of taxable income. So in terms of taxable income, your revenue would include your total sales of goods and services. It wouldn't include interest revenue. Your expenses would include wages, operating purchases, and capital purchases. So that's the upfront investments. They'd be counted as expenses in the year in which they're incurred. But then there's no need for depreciation and interest payments to be calculated in subsequent years. And so in simple terms, that you would then calculate your taxable income on that basis, multiply it by the tax rate of 5%, and subtract any previous year's losses, uplifted at our initial thinking there is around the long-term bond rate, but we're open to suggestions and feedback on that. And that would be your tax liability. So obviously, as I said, many details to work out, but that's broadly how we think this net cash flow tax would operate. There are elements of it that have been considered before in Australia, in particular, the full expensing of investments. There's various forms of that already in the current system, but our proposal goes much further in terms of calculating the liability of this for the purposes of the net cash flow tax. So that's some of the detail around the two parts of the proposal. We have had modelling commissioned by Chris Murphy to consider the investment and GDP and productivity impacts of this kind of proposal. At the end of the day, when the rubber hits the road, we think that obviously the goal here was to improve productivity and investment in GDP, and so we were very mindful that we should have modelling and some hard numbers to back up and support that. In terms of those modelled benefits, we think that this proposal will increase investment by around $7.4 billion and GDP by $14.6 billion, so around 0.5% of GDP. In the long run, it'll increase productivity by 0.4%, and it's also broadly fiscally neutral in the medium term once you include the growth impacts of what we're thinking about here. Now, there is a bit of a caveat just around those modelling results. Obviously, they may not reflect the full benefits identified earlier in terms of all of those costs of the existing system and the dynamism and competition impacts. So we think these estimates are conservative, and further analysis of impacts over time and the investment response, particularly by firms of different sizes, will be undertaken towards the final report released at the end of the year. So if we just then think about those company sizes and their investment profiles, we can think about things broadly. So in the first column on this chart, we have the current tax system. So for small businesses which have a turnover of $50 million or less, they face a company tax rate of 25%. Under our proposed changes, that would go to 20% and then a 5% tax on net cash flow. And they would pay, those companies would estimated to be, would have a significant reduction in their tax payable. In the medium businesses, so between $50 million and $1 billion in turnover, they currently face a 30% tax on income. Their company tax rate would be slashed to 20% under our proposal with a 5% tax on net cash flow. And they would see an even more significant reduction in tax payable. The numbers you see on the right-hand column there are estimates based on scenarios. It depends, obviously, on, according to the net cash flow tax, your tax liability depends on how much you invest and what situation you're in and so on. But this gives you sort of ballpark rough figures of the magnitude of these impacts. And then for large businesses with $1 billion or more in turnover, they currently face a 30% tax on income, and they would continue to face that tax. And then 5% tax on net cash flow, and the impacts on tax payable there, they either pay no more tax or slightly more. So that's broadly the direction in which these impacts on tax payable would go, but it is based on certain assumptions and so on. But I think the broad directions for each of those groups is correct. And so in terms of the overall exercise, what we considered in this report were a number of other alternatives. We thought about an allowance for corporate equity, which in the current context of the current system, you get interest deductibility. An allowance for corporate equity just says, well, you could have an additional deduction for the costs of equity. So we did look at that. We ruled that out for reasons of fiscal impacts as well as implementation complexity, but we're happy to receive further feedback on the so-called ACE proposal that's been around for a while, and in particular how it stacks up against a net cash flow tax in terms of fiscal impacts and implementation considerations. Full expensing with interest deductibility, we looked at that. So that involves businesses immediately reducing their taxable income by the full value of the investment in the year in which it's made, so which does happen under the net cash flow tax as well. So it turns out that does have a large investment impact, but if you include interest deductibility, that's implicitly a subsidy towards investment, and it's rather expensive in fiscal terms. But again, we're happy to hear in consultations and submissions about the relative benefits of full expensing with or without interest deductibility versus the options that we've put forward. And then a range of other investment incentives were considered, including accelerated depreciation or investment subsidies. In the modelling that we looked at, those sort of proposals generate less of an investment response than the ones we eventually settled upon. But again, in terms of the consultation, we are very happy to receive feedback and really generate debate for reform proposals in this area. Each of the proposals you see on this page has their merits, advantages and disadvantages, and we are very keen to, as I said, keep that debate going and receive all the feedback that we can. So in terms of the next steps, we will be commissioning further modelling and analysis to assess the impacts of the reforms that we've put forward over time, as I said, and think about the investment response of companies of different sizes. In the paper, there's a number of implementation and design challenges that we've asked for information and requests around. And so we'd be very happy to receive feedback and comments on those design considerations. And in summary, we're very keen and happy to engage with either people on this call or others around these kinds of reform proposals, particularly in the areas of budget sustainability, administrative simplicity, and economic impacts, and so on. And, if we do have it wrong, we'd like to hear from people who do think we have it wrong or right, and the reasons why. And we think that's a good way of getting towards good public policy outcomes in this particular area. So next slide, I think it's over to you, Barry.
Thanks, Alex. And I'll just move through the second element of the report, which was about regulation to promote business dynamism. We'll plan it so we can get to questions as soon as possible. As with the corporate tax measures, the key trends are pointing in the wrong direction for Australia. The restrictiveness of our legislation is growing against sort of broad ease of doing business rankings. We've declined, and the pro-competitive product market regulations has declined, and our OECD rank has declined. And this is despite having some pretty good and still good processes on paper. So something's going a bit missing between our pretty good paper process, the formal processes, and what some of the outcomes are. So we want, through this whole process, businesses to see tangible change. This is a proposal about how the system of regulation works, but we want that to provide concrete benefits for business. Regulators, in positive, and policymakers to be more responsive to evidence of disproportionate costs on business and the way that affects new proposals, shorter periods of time for regulatory decision making, and ease of navigating multiple regulators in the same space as the various regulatory stewards, which is our term for what we want to see, an approach to regulation that looks for opportunities to collaborate as they do collaborate. So, for example, there's a lot of work going on amongst the regulatory community to provide information in a more efficient way to multiple regulators, for example. Some of this is underway, but we want to fan those efforts and keep them going. Look, regulators and policymakers face poor incentives, and you told us that in your own feedback to our report. So we've got a few quotes here from published reports, some of the issues raised, excessive risk aversion, undervaluing the burdens placed on business, and you've got the quotes on the board there. Tunnel vision, that sort of sense of regulators looking and almost being mandated to look at a particular area, and not considering the wider costs to economic growth and dynamism. Now, the interesting thing is we've got versions of this slide where the quotes come completely from regulators themselves, and they're talking about how the system constrains them. So our view is that at least amongst, and you've seen the Treasurer and Minister for Finance write to regulators, there's a lot of interest from them in being able to do to address these barriers as well. The current approach isn't working. The regulators, you can see some quotes there. There's insufficient engagement with business. I think it's regulators and policymakers. The consultation's not deep, and there are no changes made after public consultation, regardless of the comments. You've seen that quote. Tools and procedures work better on paper than in practice. We've got very strong regulatory impact analysis requirements, but there's a sense from regulators and as well as industry that doesn't affect the outcome, no matter how compelling the feedback, and that regulatory frameworks have sometimes got in the way. They're either overly prescriptive about how to address a harm that's being regulated, or that they can not keep pace with the way industry is responding with technology. So where that all leads to, from our point of view, is in the policy making process, we need a more effective counterweight to the poor incentives that regulators and policymakers face. In our language, a growth mindset is the language we're using more broadly. That has to be sitting at the table as regulatory proposals are considered. So 3 main areas of regulation, and we're going to obviously elaborate on these as we develop the report. But the first element is in a government statement that really underpins this mindset shift, provides the environment within government to continue that, and make some immediate down payments in terms of reduced regulatory burden in areas of feedback. We want to bolster the scrutiny and review and evaluation of both new and existing regulations, and then we want to ensure that there's enhanced practice and almost transformation of that practice in regulators and policymakers as we go forward to provide all those the connecting cooperation that I talked about before. So the first statement, we would be wanting to see a real light on the hill type statement that outlines the growth mindset shift, committing to revise principles of good regulation with a real additional focus on growth and dynamism. We want to develop, including in consultation with stakeholders, high-level quantitative measures of regulatory quality and burden to track. So there's international work and as well as some domestic work, and develop some targets so the government can have and stakeholders can get a sense of where the government's moving. And then, as I mentioned, we want to set out concrete and immediate. The government in this statement would be wanting to set out concrete and immediate reforms to demonstrate intent. And you'll see in the report we have an information request at 2.1 to ask for examples that impose high regulatory burden on businesses. For example, examples where outcomes are overly determined, where the responses to a harm are disproportionate, and the more evidence we get on that, the more we can help advise government, in addition to some of the other work we're doing in the other pillars on specific regulations which might be getting in the way. The second element is better scrutiny of new regulation and the cumulative regulatory burden. So we're talking about enhanced cabinet processes where we're wanting to bring more of the rigour of the budget process to regulation proposals with greater consideration of aggregate growth impacts, just like in those processes. You're concerned about how that fits within an overall budget constraint here. We're wanting growth to be considered more actively as new regulations come to the table. We're proposing an independent statutory commissioner to oversee the Office of Impact Analysis. That we would hope that would raise standards for quality and timeliness of that impact analysis, and that would then flow through to its impact on decision making. Better parliamentary scrutiny. So we've got some proposals in there for Senate scrutiny, and we think the PC ourselves can play a role in reviewing those sectors where just the work of individual regulators won't get at the problem. It's often to do with multiple regulatory systems overlapping, what people call thickets of regulation. We've identified one this year in earlier work in housing construction, so that would be the ideal sort of initial priority, but there may be some others. But you'd want to look at what the existing regulatory systems and how they can be made better and produce better outcomes for growth and dynamism. So we're enhancing the practice. The last element's enhancing the practice of regulators and policymakers, really wanting that growth and dynamism to be part of everyone's mission statement. It starts with ministerial statements of expectations, setting what within legislative requirements, what acceptable risk tolerances and that might be, greater central agency support. We want stronger accountability based on KPIs and additional data collection. And we're wanting to foster a culture of regulatory stewardship where regulators are looking for opportunities to prioritise growth and dynamism. There may be some regulators, and we've had this feedback from regulators, where their own legislation stops them, like doesn't specify these things as part of their remit. So, some of these things may involve changes to better enable these priorities. So we think some of this implementation can begin quickly. The whole of government statement, getting some effective regulatory reforms where there's already evidence on the table and analysis that suggests change can be made. The improvements in cabinet and Senate committee scrutiny can occur reasonably quickly, and the central agencies already provide an element, lots of capability support, so that can be built. Then there'd be other elements that involve deeper changes, the commissioner that we propose, and improvements in policy making, regulatory practices. And then we do suggest, we don't suggest that there be a regulatory budget approach, like 1 in, 1 out, 1 in, 2 out. Those approaches have a pretty checkered history. They can be gamed, but we're thinking we'd want to keep that up in reserve if the changes that we talk about, the principle-based changes, fail to materialise. So as you know, we're in the period of consultation now. The report was out on Friday. We're looking for submissions over the next 6 weeks. And then our final report to government is in December, and then the government releases it in line with the PC, the normal requirements around PC reports. So that would be either immediately or that there's an outer limit to when they would release it publicly. I think that finishes our presentation. It gives us a bit of time for questions. Thank you for any questions submitted. I think Ben or Jeremy are going to help us, moderate and read out the popular questions, and we'll do our best to answer them.
Hi, all. My name is Ben Mitchell-Khan. I'm an Assistant Commissioner, and I'll be your MC on the Q&A. Thanks, everyone's got questions. We've got a couple of questions that go to clarifications. There's probably to you, Alex. So is the 1 billion turnover threshold just for Australian revenue, or is that worldwide revenue?
So that is revenue that's just based on Australian activities, and so it's that is what happens under the current $50 million threshold. So we're just proposing that be extended to $1 billion. It's not worldwide revenue.
All right. One from Robin Walker: is the cash flow tax deductible?
So it'll be creditable against company income tax. So in other words, if you make a loss under the net cash flow tax and you do have some company income tax payable, you could credit the negative tax payable under the NCT against the positive tax payable under the company income tax system. Having said that, though, that this is an implementation detail. That is our, that's our proposal. Other implementation details are still to be developed, and we're, keen to think a bit more about the sequencing of the two taxes, because that does matter. So we're happy to receive feedback and, further commentary and so on around that. But that is the general view, that it would be creditable against company tax.
This one is, thank you for the presentation. Very clear, new interesting ideas. One question: do intangible capital items, so expenditure, innovation, training, IP expenses, expenditure and design, etc., included as eligible items in the net cash flow tax components?
We expect that all capital expenditure would be treated as a business expense for the purposes of net cash flow tax. So we would expect that those sorts of expenses around intangibles would be counted, and you use that to then offset your net cash flow tax liability.
How do you see a net cash flow tax working for farming businesses, given their high turnover but often low margin and capital intensive businesses?
Yeah, low margin, high capital investment. I mean, this is in many ways, a net cash flow tax, is partly designed with these kinds of businesses in mind, in the sense that we want to encourage, under our proposal, more investment without thinking about specific industries. Our expectation would be that for those kinds of companies with large ongoing investments, the actual base upon which the net cash flow tax would be calculated would be, relatively low compared to businesses that don't invest that much.
The interim report characterizes this 20% CIT and 5% proposal as a first step to long-term vision. Does the PC intend to outline concrete further steps in its final report? And could those next steps involve evaluating the complete replacement of company income tax with a net cash flow tax?
So we don't think that complete replacement is necessarily a good goal. And part of the reason for that is obviously the revenue consequences. You would need a very, very high cash flow tax to completely replace company income tax. And second of all, as you lower the company tax rate, many of those distortions and economic costs that I covered in the presentation per dollar of revenue raised, they decline. And so there's a economic limit to lowering the company tax rate just for those efficiency and productivity reasons. The more and more you lower it, the less and less productivity impact you get out of it. And so this is more about general direction of change rather than the complete replacement.
Yeah. Anything you want to add to that, Barry?
Yeah, I think it's that, what we're looking at is one of the more inefficient taxes in the economy. It's not the only inefficient tax. We've focused on the one within the corporate, in the corporate area, and general tax reform. You want to take the peaks down and replace it with lower cost taxes, and that's the sort of switch we're making. But there'd be a limit around that, as Alex mentioned. But certainly, in terms of that phasing, there's a discussion there. We'd really like feedback on that. How would you provide that or integrate it into the proposal? We would like that. There's an important vision there that our vision is for effective tax rate, company tax rates to decline more broadly. The steps towards that is absolutely open to feedback on practical elements, but we are maintaining this important approach of fiscal neutrality to make sure we really push these options, because there's lots of proposals on the table. So we think it's important to really explore this fully.
Thank you. And just shifting gears, we have a question by email on the regulatory reform side. Victor Purton asks, the Commission notes the regulators tend to favour caution and risk aversion. How might we shift public policy making to reward boldness, optimism, innovation, and invention?
Thanks, and hi, Victor. I think some of the elements we talk about, so the risk aversion has to be looked at head on. Obviously, the ministerial statement of expectations, but there's also a public element to that. The risk aversion that our regulators are responding to is often the risk aversion of our community. Sometimes that's completely warranted with high harm risks, and it's important that we regulate things that involve serious harm, either at a corporate or safety or other element. Human safety, they have to be regulated. But what we sometimes do is take those sort of instincts across to less serious harms and end up regulating for low risk aversion all the time, or high risk aversion, sorry. And so getting the statement right and exploring that and stakeholders understanding some of those trade-offs, I think better scrutiny, looking at the outcomes we want from regulation rather than specifying really particular ones. The more we can often regulate for the high level outcomes we want, that gives regulators more flexibility to innovate and still achieve outcomes. For example, taking on the standards of other regulators where they're equivalent is a really common one, and we add all these Australian processes when there's a standard that we can pretty well pick from one of our own jurisdictions or a competent global authority that we'd rely on, and that allows our system to be more focused on the innovation and local compliance with that rather than imposing bespoke new standards. So, but we think it's got to be a cultural change that's partly in play, and that's why we think this concept of regulatory stewardship's worth building on. Our regulators are expressing interest in that, building that sense of looking for opportunities to improve this, and pushing it up through the system is one way that we can also reward innovation at the regulator level.
So a big picture question here from Bonnie Matheson. Growth and dynamism are good goals, but for who and what purpose? Lack of regulation in some industries and sectors leads to significant negative impacts on the health of people and even the planet. How will this be taken into account by the PC?
Where those, that's a great question, and it really does go big picture. One of the themes that you'll see through the 5 pillars is that we should try and regulate, harms as directly as possible with the most the best instrument and not regulate it 2 or 3 times. So, for example, we've just put a report out last night, and this morning you'll see it in the press on net zero transformation. I've been involved with that. That has some things in that around really taking the climate challenge seriously, regulating and having policy settings that really get that regulate that or deal with that issue efficiently, and then we don't keep dealing with it with less efficient instruments as we go. So what we want to do is take the harm that we're talking about really seriously. We haven't got a narrow approach to just measured economic growth. There's a wider set of things that matter, but being really careful in then how we think about what the best policy instrument to address that is, and then trying to make the other instruments around that less harmful for growth. So we think you can balance those two and have a really thriving economy while regulating the things that matter.
And just on the detail around ministerial statements, we've got a question from Dan saying, do you envision that your recommendation for ministerial statements of expectation to focus on growth and dynamism and acceptable risk tolerance apply for all government portfolios, finance, defence, education and health?
We would imagine it where there's an independent authority that ministers have oversight of and have we would imagine applying to that rather than, I think departments of state with their non-regulatory functions will, that there are advantages and of thinking about that as well, but we're really focused on the functions, those organisations that have regulatory functions, and that's the primary aim here.
And there are a couple of questions around unrealised capital gains and the proposed and policies around that. So I might just address those. So we didn't look at current government proposals around that for the purposes of this report. We confined ourselves to the big picture around Australia's corporate tax rates and those broad directions of reform, and that was a judgment that the Commission made to focus on those areas. Having said that, we are happy to receive and feedback on this proposal and other proposals, but we really are focused on big picture reforms of Australia's corporate tax system for the purposes of this report, in addition to the regulation side of things.
Well, thanks for jumping in, and you guys can both see the thing. I'll publish the questions as you reply to them as well. We've had a couple of questions that sort of relate to the question of, is a cash flow tax something that commonly occurs overseas, or how does that tax affect dynamism overseas, and what have you seen there?
So it's a good question. There are certain elements of cash flow taxes in other economies, but none that are like the proposal that we're proposing here. In Australia, there are, again, elements of a net cash flow tax within the current system. So there's, there was full expensing during the COVID period. Having said all of that, the key consideration one of the key considerations in thinking about this was that the key elements of calculating tax payable and so on, are there in the current reporting, we think. So that's one consideration. And in terms of the dynamism point, that was front and center in thinking about this tax. One consideration is that it by allowing you to fully deduct investment expenditure at the time at which it's incurred, that is more supportive of investment than the current company tax system. And the second component is that threshold of $1 billion in turnover or less, where giving them a company tax rate of 20% really does, we think, encourage younger firms, startups, more innovative firms, and it is where the bulk of investment in Australia actually happens. So that was a key part of the dynamism story.
We've got two questions thinking about R&D, particularly, I guess it's for you, Alex, broadly, but have you considered the impacts of higher rates of tax on large businesses for expenditure R&D, which is important for innovation productivity growth?
So, research and development spending is responsive to tax rates. There are existing tax incentives specifically for R&D in our current system. We took those as given. We were thinking more about all investment more broadly, and we wanted to add the greatest value where we could, noting that there's other things and other inquiries and reviews that are going on. And I think one of those that's happening at the moment is into R&D tax incentives. So we were mindful that that was occurring, and we thought it'd be better to look at the tax system more broadly. But again, happy to receive feedback and advice from those on this call or elsewhere around the R&D tax incentive or R&D expenditure more generally.
And I got one here on the modelling, particularly from Sherelle Murphy. In the modelling, does the modelling consider the foreign investment implications of an effective higher or lower rate of company tax for large companies, or effective higher rate in this case?
Yeah, so the modelling does take those impacts into account, and so we think that this proposal would encourage greater foreign investment overall, and that's borne out in the slide that I put up on the investment response. So it does take into account all of those impacts. But again, there is further work to do around, as I said, the size distribution of the investment impacts. We have an aggregate impact that we think is reasonably robust, but we'll do some more careful thinking around the impact by size of firms.
I think this is sort of in the same vein, but I'll put it to you. The interim report makes the case that lowering the company income tax rate will attract more foreign investment. Do we intend to model where that benefit will be offset other than holding a hot by introducing a net cash flow tax? So does the sticking price matter?
Yeah, so the modelling does take that into account. Yeah, so the two channels that I broadly outlined in the slides are greater investment from abroad because after tax rates of return are higher overall, and then you get an impact for firms that have domestic shareholders because of that retained earnings impact.
Excellent. We've got one for you, Barry, on the recommendation, particular recommendation 2.2. Has the PC considered how the Independent Statutory Commissioner to oversee the Office of Impact Analysis would interact with the ALRC and or parliamentary scrutiny? Did you consider a parliamentary budget office type institution instead?
Looking at the first one, and Ben, indeed, you might jump in on this, but we don't see there being any inherent overlap with the proposed commissioner and those other institutions. In a sense, there already is an Office of Impact Analysis that already publishes elements. This was to strengthen that. There's no particular, it doesn't opine on the outcome of those, whether the right policy is recommended. It's about the quality of the analysis of costs and benefits, whether they're highly uncertain, they might be uncertain inherently. So the quality of the impact analysis is a process, and this just brings further light onto that and some additional accountability around that. As to the PBO, we don't give other institutions jobs lightly. They're pretty busy with the current mandate. We thought the better way, we thought about those things in a broad sense, where's the right institutional place, and thought when we looked at the Senate scrutiny process, it didn't seem to have enough explicit attention to growth and dynamism as it considered regulation. So that was where we just thought the best element would go.
Thanks, Barry. I've got one from Catherine Tay to you, Alex. Have you considered different tax rates for startups? We have an issue of new business success, and this could help new businesses establish themselves.
Yeah, so it's a good question. So the proposal that we're putting forward has that in mind. We recommend a lower tax rate of 20% for firms with turnover below $1 billion, which includes startups as well as innovative established companies. So we think that is the right approach. Having said that, again, Catherine, if you'd like to make a submission around different tax rates for startups, we'd be happy to receive a submission along those lines.
Just to add, Alex, that the cash flow tax itself has really desirable characteristics for startups at the moment. One of the key areas where you see that the discouragement of the current system on risk and is around the asymmetric treatment of losses. Cash flow tax will allow losses to be carried forward by a wider range of companies and be more useful earlier. So that's in some ways one of the strongest areas where you'd expect this combination to encourage dynamism that is not there at the moment.
Thank you both. Thank you everyone for your questions. We have not gotten through all of them. Remains for me to thank everyone. I'll let Barrett and Alex say thank you, and I'll stop talking.
Thanks, Ben, and thank you everyone for attending today. I hope that's been informative. And Barry, did you want to add anything?
Just really looking forward to people's responses. We're looking for both, direct responses at ours, and if people can work up alternatives that produce the same sort of outcomes with then we're really interested, because it's the outcome that we're really focused on, both on tax and regulation, greater dynamism, greater investment. So really welcome inputs to that discussion.
Thanks, everyone.
Thanks, everyone.